Based on the type of information they provide, multiples can be grouped into several major categories: activity, liquidity, solvency, profitability, and valuation ratios. There is a wide variety of financial indicators you can estimate for every single company. So, our next task is to calculate and interpret the most commonly used financial ratios in each of these categories. Well, let's take it one step at a time. In this video, we will examine the major activity ratios. They are often referred to as asset utilization or turnover multiples. Overall, they tell us how efficient a company is in utilizing its assets. So we have receivables turnover, inventory turnover, payables turnover, and total assets turnover. We calculate them by simply dividing a respective P&L item, revenue, cost of goods sold, or purchases, by the average asset base from the balance sheet. We can also estimate a fixed assets turnover or even working capital turnover. Please pay attention that whenever a balance sheet item is employed in the calculations, normally we take the average balances over 2 consecutive years rather than end-of-year figures. This practice kind of smooths the outstanding amounts and limits distortions in case of significant fluctuations. To find out the average inventory balance, for example, you need to take the sum of inventory balance at the end of the current and previous years and divide it by 2. Okay, keep this rule handy. We will use it shortly. Now let's take a closer look. What do all these metrics have in common? That's right. Despite the specifics, they all measure the efficiency of day-to-day operations and resource utilization. All right, great. Learning formulas by heart is fine. However, we need to go deeper than that. Let us analyze the receivables turnover indicator. Do you still remember the 4 W's that facilitate a ratio analysis? Yes. First, we need to ask, what does this ratio show? In this context, it evaluates the efficiency of a firm in collecting its trade receivables in a timely manner. The ratio illustrates the number of times that a business manages to collect its outstanding receivables from clients per year. High receivables turnover is an indication of a conservative credit policy where firms require short payment terms with customers, or of efficient collection departments, meaning companies manage to collect a great portion of its outstanding receivables. Generally speaking, the higher the ratio, the better. So, what does a change in the ratio mean, you might ask? If the receivables turnover goes up, this is an indication of improving collection efficiency. Alternatively, if it goes down, this signifies increasing bad or doubtful accounts. What's the norm, though? Well, it depends on the industry, the region, the county of operations, and so on. There are no universally agreed values. When analyzing turnover ratios, you should always compare your results to the average of a peer group of companies. And finally, can you think of the limitations this ratio might have? Yes, its usefulness, similar to most financial ratios out there, is limited to the quality of the published financial statements. What if the net sales figure is overstated because of aggressive revenue recognition policy, or trade receivables are understated in financial accounts? Then, this ratio will not accurately show the firm's ability to manage trade receivables. Excellent. You can perform the same type of analysis for the payables or inventory turnover ratio. Again, the higher these multiples are, the more efficient a company is in its daily operations. Okay, moving forward, the so-called days ratios are closely related to turnover ratios. We need to acknowledge their existence for several reasons. Once you calculate receivables turnover, you can easily convert it into days of sales outstanding. We simply need to divide 365 by the turnover ratio. In like manner, you could obtain the number of days of payables and days of inventory on hand. Why would we do that in the first place? For the sake of simplicity, of course. It is easier to analyze efficiency in terms of days. At its core, we use the very same information, just presented in a different way. How about an example? Imagine that accounts receivables of ABC Corporation turned over 10 times during the past year. This means that it takes the company 36.5 days on average to collect its receivables. It is standard practice to compare the figure to the number of days of payables, say 20. This way, we come to know that the firm pays to its suppliers in 20 days on average, while it takes 36.5 days to collect its receivables. It sounds like cash shortages are inevitable here. All right. To complete the picture, companies usually calculate and monitor their cash conversion cycle as well. It is calculated as the sum of days of sales outstanding and days of inventory less the number of days of payables. The cash conversion cycle, or CCC, measures the length of time, in days, it takes a firm to convert its investments in inventory into cash inflows from sales. In other words, this is the time needed to get back the invested funds. Let's visualize all this. The green bars show the number of days related to cash inflows, while the red one corresponds to the days of payables, or cash outflows. The cash conversion cycle is the difference between the two. For companies, a long cash conversion cycle is considered undesirable. The longer it is, the higher the firm's working capital. Why? Imagine a firm that doesn't manage its accounts receivables well. It has a lot of doubtful receivables to collect. At the same time, it pays to its suppliers diligently, shortly after the invoice date. As a result, current assets, inventory and accounts receivables, will be significantly higher than current liabilities, accounts payable. Thus, working capital will increase. This will lead to a longer cash conversion cycle due to more money locked up in operations. On the contrary, shorter cycles lead to greater cash-generating ability and less need for external financing. Of course, before you decide whether the cash conversion cycle of an organization is too long or too short, you need to compare it to the industry average. For illustrative purposes, we will examine the relevant indicators of several well-known companies. As we can see, these figures vary significantly, depending on the industry and type of operations. For instance, Walmart stores and Chipotle Mexican Grill typically sell on a cash-only basis. Thus, they have very low accounts receivable days. Similar results hold for Southwest Airlines, because many of their customers pay in advance for airline tickets using cash or credit cards. What's more, inventory days represent the largest share, in percentage terms, for corporations such as Tiffany & Co. and KB Home. This is because their products have long production and sales cycles, unlike the Washington Post, which, understandably, maintains minimal stock. What else do we observe? These firms have a wide variety of cash conversion cycles. For example, Amazon and Southwest's CCCs are negative. In fact, receiving cash from customers before they need to pay suppliers is what makes that happen. Every sale these firms make generates a cash inflow that can be put to work immediately. On the other hand, companies like KB Home and Tiffany & Co. spend money on manufacturing goods, which they convert into cash in more than a year's time. That's some lengthy production process there, isn't it? All right, this brings us to the end of the video. The following lesson is all about practice. We will teach you how to apply activity ratios to real-life businesses in no time. See you there. Thanks for watching.